Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. The idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers, and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they are influential people, and what they say matters a lot because of their experience and background. So, I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully, it'll give you a wide and useful perspective. For all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description below. With that out of the way, let me get started. Today, I'll start with talking about cement. UltraTech's results recently came out and the management sounded extremely bullish about the economy. I wanted to understand why. What I found was a larger story about public infra and private capex and the gap between them. Let me start with what UltraTech CFO Atul Daga said on the earnings call.
Let me get on the main core topic for discussion which I have in mind today. Demand. That is the most important aspect for our business. Everything else becomes secondary and falls in line.
And for the next several minutes, he proceeded to lay out an exhaustive region by region catalogue of infrastructure projects across India. Punjab is spending 16,000 crores rupees on road development. Delhi Metro is announcing new corridors worth 12,000 crores, and the list just went on. One analyst even joked that it sounded like a union budget speech. But he wasn't just listing projects for effect. He was making a specific argument about what these projects mean for cement demand. Elevated metros, for example, require 11,000 metric tons per kilometer. So when you read that a city is adding 80 kilometers of elevated metro track, that's potentially 880,000 tons of cement. And he was explicit about where this demand is coming from. Government's focus on infrastructure.
And as we see the progress, government's focus on infrastructure is translating into a robust pipeline of new projects nationwide, with several marquee investments announced across every region, translating into solid demand.
Remember this point and I'll come back to it. See, if UltraTech is seeing the demand picture from the cement side, JSW Steel is seeing it from the side of steel, a material just as important to infrastructure. And what JSW Steel described in their results was similar. When asked about which sectors would lead this growth, management's response echoed UltraTech's thesis.
We are seeing good growth in industrial and now post the GST announcement, especially in the consumption side, automotive, appliances. The other area is the renewable energy. And
JSW Steel also provided a useful piece of context that explains why October and November were weak for both cement and steel.
Central government capex, while was low in October, November, but is up 28% April to November due to a strong H1. The annual capex target looks to be on track.
Government spending was front-loaded in the first half of the fiscal year, then slowed in October to November. When government projects paused, contractors stopped ordering materials, demand softened, and prices fell. But with the full-year capex target still on track, both companies expect a strong Q4 as spending catches up. So far, this is a very straightforward story. India's two largest building materials companies are seeing strong demand driven by government infra spending. Now both are confident about the future. Both are investing heavily to capture it. However, when it comes to private capex, the confidence isn't as strong for infrastructure or real estate. Now JSW Steel seems to indicate otherwise when they said,
conditions for private capex is increasingly becoming conducive, supported by a healthy balance sheet and RBI's recent rate cuts and lower inflation.
Now conditions may be conducive, but is private capex actually picking up? Now before I answer that, let me quickly explain why private capex matters a lot. See, there's a meaningful difference between an economy powered by government spending and one powered by private investment. When the government builds a highway, it creates demand for cement and steel and labor. But once the highway is built, that demand stops. The government has to keep announcing new projects and keep borrowing to fund them, just to maintain the same level of activity. Private investment works differently. When a company builds a new factory, it does so because it expects to sell products for years. That factory employs workers who earn steady wages. Those workers spend their wages on goods and services. That spending creates demands for other businesses. Those businesses then invest to meet that demand. It's a self reinforcing cycle that doesn't require the government to keep borrowing. Projects Today is a firm that tracks new investment announcements across India. Their CEO Shashikant Hegde highlighted his concerns on private capex to business standard. Private sector investment intentions have fallen for 2 consecutive quarters. Government investment announcements, meanwhile, rose sharply. The public sector's share of new investment proposals climbed from under 30% to nearly 36% in just 1 quarter. The government is stepping in to compensate for private sector hesitancy. He explained what's happening. While domestic macro conditions remain supportive, often described as a Goldilocks phase with stable demand and manageable inflation, the willingness of private promoters to commit to large new capex may remain cautious in the near term. Global headwinds, including renewed tariff related risks, geopolitical uncertainty, and a softening export environment, are likely to keep risk appetite restrained and delay final investment decisions in private led sectors. Now, this quote is something worth unpacking. By textbook metrics, conditions look good. It's a Goldilocks environment, not too hot, not too cold. But private companies aren't investing anyway. They are in a wait and watch mode, uncertain about global trade, worried about geopolitical risks, and unconvinced that demand will be there when their new capacity comes online. Remember JSW's comment that conditions for private capex are increasingly conducive? The Projects Today data suggests that conducive conditions aren't translating into actual investment. The ability is there, the willingness isn't. This gap between conducive conditions and actual investments is not new. In fact, it has persisted for over a decade. We wrote about this in Daily Brief a few months ago. Private investment as a share of GDP peaked at around 27% in 2007 to 8 during India's pre-financial crisis boom. Even after the global crisis hit, it recovered to about 27% by 2011 to 12. But since then, it has been on a steady decline, sliding to around 21% by 15 to 16 and hovering there ever since. The government has tried everything to revive it. After the NPA crisis hit that peaked in 2018, it cleaned up bank balance sheets and recapitalized public sector banks, hoping that freely flowing credit would unlock investment. But it didn't. In 2019, it slashed corporate tax rate, one of the steepest cuts in India's history, hoping that higher profits would translate into more investment. They didn't. It launched PLI schemes to directly subsidize investment in targeted sectors. And when none of that worked, it ramped up public capex to historical levels, hoping that government spending would eventually crowd in private investment. The result? The private sector share of total fixed investment has actually shrunk from over 40% in 15 to 16 to just 33% in 23 to 24. Not only has overall investment as a share of GDP declined, but the private sector slice of that shrinking pie has gotten smaller too. The problem, as we noted in that piece, was never liquidity or incentives. It was demand and confidence. Companies invest when they believe customers will be there to buy what they produce. If they are not convinced that demand will materialize, no amount of tax cuts or cheap credit will get them to build new factories. Writing in the Financial Times earlier this month, Ruchir Sharma put it bluntly. It is no coincidence that domestic private investment in India has also been anemic over the past decade, held back by the same regulatory maze and overzealous bureaucracy that foreigners complain about. And boosting investment, both domestic and foreign, is the key to creating jobs and stemming the exodus. These aren't problems that government infra spending can solve. You can build all the highways you want, but if companies don't trust that the games of the rule will remain stable, they won't invest. Now, none of this means UltraTech and JSW Steel are wrong about what they are seeing, but the composition of that demand matters. When UltraTech lists dozens of government infra projects and says demand is everything, he is describing an economy where the government is doing the heavy lifting. When JSW Steel says conditions for private capex are conducive, but the data shows private investment falling, that's telling you something about the sustainability of this growth. The infrastructure wave is real, but for it to translate into durable, self-sustaining growth, private investment has to follow, which hasn't happened yet. And governments, unlike private companies, eventually run out of room to borrow. That's it for this episode. See you in the next one.